I'm going to introduce our next speaker. Her name is Kaaren Hall. Kaaren has spent 17 years in the broadcast industry before moving into the real estate and mortgage space. She is now the CEO of uDirect IRA Services, of which I am a customer, and serves in various leadership roles in organizations like the Retirement Industry Association and Council on Aging in Southern California. Kaaren, welcome.
Thank you so much, Bruce. Screaming round of applause. Thank you. Normally, everyone is in circular tables, and it's a big room. We're at the Mission Inn or at the Center Club or something. So instead, I hope you're enjoying your coffee this morning, and thanks for joining us. Really appreciate it. What I want to do right now is cover the basics of self-directed IRA investing. We'll cover the basics, but when it comes to what's new, what's changed, we'll get to that later on when we do the Q&A at the end, so stick around. So uDirect IRA Services is my company, I'm CEO, and what we do is we help you to invest outside of Wall Street, invest in alternative assets. What we don't do is offer tax and legal advice. And fortunately for tax advice, we have Keystone CPA here today. And for legal advice, well, Harry Barth is going to be joining us later on, so stick around for that. With self-directed IRAs, what's important to know is that they're for retirement purposes only. You can use self-directed IRAs when you're raising capital. It's a great tool to raise capital. And a lot of people do. In fact, there's something like $31 trillion in American retirement savings altogether. And it's a big tool, and to use when you can tap into that much money. And $31 trillion is a tremendous pool of money. But it's also great for your own personal retirement savings. Remember that it's for later. Self-directed IRAs are also, of course, for retirement purposes only. So you're not going to invest in asset classes and enjoy those benefits today. It's all about later. And that's why we get some tax benefits for our self-directed IRA investing. So when it comes to self-directed IRAs, they've been around for something like 45 years. It's nothing new. So many people, though, haven't heard about self-directed IRAs. So they were founded, it was 1974 when the ERISA Act was signed. It went into effect in 1975 and created IRAs. A self-directed IRA is just like any other IRA. The rules for the way the money goes in, the rules for the way the money comes out, they're all the same rules. The only difference is the asset that the account holds. That's what makes it self-directed. And so you can invest in all different kinds of things except insurance contracts, life insurance contracts, and collectibles, the only two things. Now, you may go to a self-directed IRA company and say, hey, I want to invest in this, and they tell you no. And that's because each custodian can make a business decision for which assets they choose to custody. And if they decide not to custody your asset, it's because it's not administratively feasible, okay? That's what that means. Any conversation about self-directed IRAs must include a conversation about the rules. Self-directed IRAs are definitely not like investing with your personal cash. It's just a microcosm. It's a different set of rules. So to learn some of those rules for traditional and Roth IRAs, you can go to publication 590 on the IRS's website, irs.gov. Now, a couple of years ago, they broke it down to 590A and 590B. 590A for the way the money goes in, 590B for the way the money comes out. Very informative. If you care to read about it, you can learn all the rules of IRAs, but with self-directing goes a little deeper, and we'll cover it. So with self-directed IRAs, you don't use an IRA as collateral for a loan. You're not going to ever borrow from an IRA. You can from a 401k, but not from an IRA. And there are some other rules that are involved too, and they're called prohibited transactions. So let's go forward. Prohibited transactions really start with who is qualified and who is disqualified to your IRA. So the disqualified people are your lineal ascendants and descendants, right? It's your parents and grandparents, you and your spouse, your children and your grandchildren. They're disallowed to the IRA. But the people who are allowed to play the self-directed IRA game with you are the people who are out to the sides on the family tree. And thank you so much. And those people would be your like aunts and uncles, cousins, brothers and sisters, nieces and nephews. They are allowed. So let's go to the next slide on that one. I should mention with disqualified people, in addition to the lineal ascendants and descendants, also disqualified would be a 50-50 business partner or any fiduciary. But again, qualified people are the people out to the sides on your family tree. Your IRA can make a loan to your brother. Your IRA can buy a house and your uncle can move in, but not your dad. You see, you need to know these rules before you get started. So now we know who can play the game of self-directed IRAs. Now we want to win the game. And so to go on to the next one, we'll talk about the different kinds of prohibited transactions. Neither you nor a disqualified person can benefit from the IRA. You can't buy, sell, or exchange assets within the plan with a disallowed person. So what that means is, for example, your kids aren't going to buy a house your IRA owns, and you're not allowed to provide what's called services to the plan. What that means is that you cannot swing the hammer, you cannot nail the nails into property that your IRA owns. If you're a realtor, you don't get a commission, so you have to stay arm's length from all your transactions. And moving forward, the pros and cons of buying real estate with a self-directed IRA, pretty important. Number one is that, we'll start with the pros. My favorite one is the ability to really grow your wealth so much more quickly because the proceeds aren't diminished by tax. That's really the number one thing. An IRA can even borrow money, which we'll talk about. It may not be what you think, but you really do get to compound your money faster when you get the return back, and 100% of that return can go up into your next deal. The downside about investing with a self-directed IRA, the con side, is that you don't get the tax breaks that you normally get when you invest with your personal cash in, say, for example, real estate, which is, there you go. And of course, you're solely responsible for all the gains and losses. And those losses, if you do lose money in a self-directed IRA, it's hard to replace because of contribution limits. So always make sure that you take the proper time to do your due diligence. And if you don't know what that means, well, guess what? Call me and I'll help. That's what we're here for. Your IRA can borrow money. And people get this really wrong most of the time. It's a very common mistake to think you can go to your bank and get a loan. And that is not the kind of loan that an IRA can take because there's no recourse against the IRA, right? So it's called a non-recourse loan. If your IRA were to default on that loan, then the lender can only come against the subject property, not against you personally, not against any other assets within the IRA. All right, so it's a non-recourse loan. If you like, uDirect IRA Services has a list of non-recourse lenders we'd be happy to share with you. Now, usually these lenders require a higher down payment. When you buy a house personally, sometimes you can come in with 3%, but when your IRA is acquiring real estate, they want more skin in the game typically. And we can go ahead. Now, you cannot personally guarantee this loan. Why? Well, if you think about it, you're disallowed to the IRA. And if you personally guarantee a loan to your IRA, you're offering benefit to the plan, and that is a prohibited transaction. So you can't personally guarantee the loan. Okay, so when your IRA does borrow money and does take on a non-recourse loan, really important to know that your IRA could be taxed. And Matt and Amanda can go in depth on this either today or perhaps you can call them and discuss this with them privately, but it's called UDFI, Unrelated Debt Financed Income Tax. And it's a tax on the proceeds that the IRA earns because of debt. There's another kind of tax, and that tax is called UBIT. So an IRA can also sometimes face a UBIT tax, unrelated business income tax, when an IRA invests in an active business. Read about both of these taxes on the IRS's website. Again, go to irs.gov to read about it. It's publication 598. Okay, and then you can read about these taxes and you'll be up to speed. Another big tool with self-directed IRAs that you can still use is commonly called the checkbook IRA. What it really is an IRA-owned LLC. It's a special purpose LLC, typically single member, sometimes multi-member, but usually single member. Your IRA will buy 100% of the initial shares of this IRA, and then you can use the checkbook from this LLC to invest your IRA funds. You have to follow all the same rules, all the IRA rules. So you may not know what those rules are, so you can always call us if you need clarification on how to manage your IRA-owned LLC. We'd be happy to chat with you about it. Now, as I did mention before, losses. If your IRA were to invest in something and that deal doesn't go through and you do actually lose money, then you have to actually get a valuation on that asset to prove that you lost money. So this is another reason why you really need to do your due diligence and make a good investment up front, because it's difficult. Now, with self-directed IRAs, as we move forward, we call it self-directed IRAs, but it's so much more. It's all of these asset types that you see, or account types that you see here. Traditional, Roth, SEP, simple, spousal, inherited, solo 401k, even the ESA and the HSA can all be self-directed. So how do you do this? How do you self-direct? It's a 3-step process. You open an account, get it funded, and then invest. Open, fund, invest. That is pretty straightforward. If you'd like more information, if you'd like that list of non-recourse lenders, or like to find out more about self-directing, you can give us a call. But I really want to thank the Norris Group for making this all possible today. It's all because of their diligence that we have been able to come together and meet with you on Zoom this morning. So with that, I will turn things back over to Aaron to introduce our next speaker. Thank you so much.